Good morning everyone and welcome to another Morning Markets here at True Potential. So the impact of high inflation continues to deepen upon asset prices. Equity markets yesterday displayed very unusual activity as the daily volume rose 20% in this downdraft of prices. We have to go back to the initial period of COVID lockdowns to see similar two-day moves in equity indices. Now markets are moving to price much tighter monetary policy, and this explains the immediate weakness in equity prices. Remember, we have the US Federal Reserve meeting tomorrow, the Bank of England meeting on Thursday, where both central banks are expected to raise interest rates. But the fear is that these central banks maybe have to raise interest rates much quicker and higher than was expected just 1 week ago to try and bring inflation down to a more acceptable path, rather than just allowing inflation to gradually cool as base effects bring the month-on-month numbers down towards the end of the year. The real worry is that central banks are going to have to raise interest rates to slow actual consumption and actual spending from consumers, particularly in the US. Now, even if the central banks do act as some market analysts expect and raise interest rates much quicker, maybe this week, but perhaps over the rest of the summer, they may not have an immediate impact upon inflation. And that's because the primary driver of these inflation peaks that we're seeing is to do with the energy complex, and in particular oil markets. And recall yesterday the update on US food price inflation, which is 10%, and also transport costs, the very broad effects of energy markets. These can't really be controlled by central banks. The primary problem here is a lack of supply in the oil market. So we are seeing very unusual correlations in these asset markets. In fact, there's a less than 5% probability of seeing this strength in oil markets and this weakness in equity prices. And this is going back all the way to the early 80s. Now, in addition to the challenge of inflation, which is driving weaker equity prices and weaker bond prices, is the spectre of volatility again. And that is that markets now expect large daily swings in equity prices in either direction over the next month. And until this calms down, we may not start to see some stability in equity prices. This reflects some of the unusual moves we saw back in early March, but then we saw some recovery through the month. So we need time and patience just to allow these implied measures of volatility to calm down. Now, to reaffirm the broadening inflation pressures we've seen in Europe, the UK and the US, we've actually seen 30-year high in inflation prints in both Finland and Sweden this morning. So it's not just a G3 problem, it's a very broad inflation problem across developed markets. But we have had some good, strong data from the UK this morning, and that's the jobs data. So despite a small uptick in the unemployment rate, the UK jobs market remains exceptionally tight. We have a new record in job vacancies of over 1.3 million jobs available. There is some underlying challenges, in particular for the economy. The number of people who are unable to work due to long-term sickness is now around 400,000. And this partly explains the tightness in the jobs market, which is that until these workers can come back into the market, we are likely to see continued lack of supply of workers, but also wage pressures. Wages rose about 4.2% when we exclude the volatile component of bonuses. It was around 6% when we factor in these bonuses. So despite some of the weakness we've seen in the UK economy, recall that yesterday we updated on a weakness in GDP for the month of April, there is still very strong demand for workers. The number of people entering the job market continues to increase month on month. 177,000 for the month of March entered the job market. So this is exceptionally strong. This is a bedrock for economic growth. There are challenges from the energy complex, as we've discussed. However, we are hopeful that for as long as corporates remain upbeat about their future, that the jobs market can remain strong and support the economy. That's all for today. Thank you very much.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.